Welcome to Identifying New Markets with Alternative Credit Data webinar. This presentation is being brought to you on behalf of FactorTrust. Joining me today is Dan Richard. Dan is responsible for driving strategy, planning, and execution for analytics, product strategy, and data acquisition as the VP here at FactorTrust. Dan is an expert at leading the development of scoring models and attribute suites for business use cases. Prior to joining FactorTrust, Dan served at Equifax as a Senior Director in Enterprise Analytics. Dan holds a Master's in Statistics and a Bachelor's degree in Industrial Engineering from Georgia Tech. With that being said, I'm going to turn things over to Mr. Richard to begin the presentation for you today. Dan?
Thanks, Christine. Good afternoon, everyone. Today I'll start us off with a brief introduction of FactorTrust, provide a detailed examination of non-traditional borrowers, and touch on the usage of public record data in financial services. I'll then lead us through several demonstrations of how alternative credit data is used by traditional lenders today and discuss actions that lenders can take now to explore and integrate alternative credit data into their decisioning. Lastly, we'll finish up with an interactive question and answer session moderated by Christine. To get us started, I'd like to share some interesting results from a recent survey that FactorTrust conducted. About 200 financial services industry experts participated in the survey, and these participants represented banks, credit unions, and finance companies, many from the auto vertical. Roles at these organizations spanned a wide spectrum, including risk, marketing, technology, operations, product, compliance, and C-level management. We asked respondents to rate how important alternative credit data is to their credit strategy. 44% indicated that they currently use alternative credit data, with half of this group, or 22%, indicating that it is very important to their credit strategy. 11% have tested it and are still exploring how to use it, and another 18% plan to explore it in 2017. Roughly a quarter of respondents indicated that they do not currently use alternative credit data. Overall, the poll result indicated a fairly diverse assortment of exposure levels to alternative credit data in the financial services industry. For those listening today who are already familiar with alternative credit data, I trust the content and analysis we provide today will only add to your growing knowledge base. For those still gaining their understanding, we provide today's insights as a way to introduce you to alternative credit data, and we offer steps to take now to make sure you're ready to evaluate and use it. Look for me to reference two other fascinating poll questions from this survey as we go along through the material today. To begin, FactorTrust is the Alternative Credit Bureau, a leading provider of underbanked consumer data, analytics, and risk scoring solutions on those underserved by traditional banking channels. We have been serving the underbanked industry for more than 10 years, using a contribution model where all lending customers contribute inquiry and credit data. Our core competency focuses on credit risk and credit marketing. We provide credit lifecycle solutions for account acquisition, account management, and collections. Furthermore, we were also recently honored as the fastest growing private credit bureau per the Inc. 5000. We've seen a great deal of growth during our tenure, and it's exciting to grow along with the underbanked consumer data industry as fast as we have. Taking a quick peek inside the credit database, you'll see the types of lenders that contribute data to FactorTrust specialize in lending to non-prime consumers. We serve many markets, including alternative lending, auto finance, installment lending, retail finance, credit cards, collections, title, and rent-to-own. We have a reciprocity-driven business model in which lenders pull our FCRA credit data and contribute their own loan data in real time through our proprietary loan reporting process. Our solutions are driven by our unique proprietary data and analytics. Furthermore, FactorTrust has been studying the financial behavior of underbanked consumers for quite some time. In our Underbanked Index, we publish insights about non-prime consumers' earning and borrowing characteristics, such as average monthly income, borrowing frequency, and delinquency rates. For example, in the edition shown here, the bar graph in the lower right demonstrates the significant increase in short-term loan borrowing activity that occurs in the fourth quarter, primarily driven by the holiday shopping season. We've discovered great potential for lenders and auto finance service providers to leverage these and other insights to enhance their understanding of underbanked consumer behavior. And finally, let's survey the landscape of alternative data types used in credit decisioning today. FactorTrust provides proprietary alternative data solutions in fields even beyond alternative credit data. These include employment and bank account verification solutions and alternative data risk scores. We also partner with other alternative data providers to broaden our solution suite for the benefit of our lending clients. Now, when the topic of alternative data comes up, it's oftentimes in regards to social media. Social media data holds tremendous potential for lenders and other businesses to both understand consumer behavior and even to influence it to some degree. Things like purchasing preferences, network influence, customer satisfaction, and even potential fraudulent behavior can all be detected using social media data. However, because of regulatory compliance requirements in the consumer financial services industry, a line is drawn around data that can be used for credit decisions involving potential adverse action, which is when a consumer is declined for credit. The sources I show on the landscape diagram here are fairly commonly used in financial services, in large part because the companies that provide them are regulated under FCRA, ECOA, and other fair lending regulations. It is these types of regulated data sources and alternative credit data in particular that will be the main focus of today's discussion. The second of our 3 recent survey questions asked respondents to indicate the various ways they use alternative credit data today. Of those that currently use it, the most prevalent use case, with 32% responding, was credit decisioning, such as an overlay to a risk score. A close second, with 30%, was applicant verification, for example, validating an applicant's identity. Other lower-sided use cases with 15% apiece were servicing, such as an alert on risky activity, and loss management, for example, prioritization of collection efforts. These are fascinating findings, to be sure, and roughly in line with the array of use cases for which FactorTrust serves its clients with our unique alternative credit data. Now let's get the ball rolling with a look at the traditional credit and alternative credit profiles of non-traditional borrowers. First, I'll define the segment of the market at the focus of today's discussion. Non-traditional borrowers often are identified with the term underbanked, which the Federal Reserve describes as consumers that have had a depository account but also used at least one alternative financial service in the prior year. What is an alternative financial service? The classification comprises the many financial services used most often by consumers with subprime credit. These services include short-term loans, auto title loans, and check cashing, among others, and they are not typically captured in traditional credit reporting. Now, a note on short-term loans. Many equate short-term loans with payday loans, which was pretty spot on a few years ago. However, the alternative financial services industry has been undergoing a transformation in recent years, driven in large part by regulatory pressure. Many lenders have transitioned to offering unsecured installment loan products. These generally have APRs above 36% and are shorter in term than most traditional unsecured loans, so think 3 to 9 months. They are originated either online or in a storefront setting, and the loan amounts often range from $1,000 to $5,000, which is between the size of a payday loan and most traditional unsecured loans captured at the big three bureaus. So in accessing alternative credit data, as the industry continues its transformation, lenders can expect to see more and more of these types of installment loans in their applicants' alternative credit files. Moving on, what may come as a surprise is that most of these non-traditional underbanked borrowers actually have a footprint at both an alternative credit bureau and the traditional big three credit bureaus. In other words, these borrowers are not as off the grid as popular perception often entails. In fact, we found in a recent study that 77% of consumers that applied for an alternative credit in 2015 had a credit file both at FactorTrust and at a traditional bureau. An additional 19% not found at FactorTrust were found at the traditional bureau. It is possible many of these consumers were first-time applicants for alternative credit. An additional 2% were found only at FactorTrust, meaning they had no traditional credit file. For these consumers, their only credit history would be found outside of a big three bureau. Finally, 2% were found at neither bureau when they applied for a short-term loan. Now, the fact that nearly 80% of non-traditional borrowers have some or all of their credit history residing outside of a big three bureau means a few things. First, that a big three credit file will paint only a portion of these consumers' financial pictures. But also, these consumers that are active outside of traditional verticals actually have interesting nuances about their traditional credit files. Let's take a detailed look. If we start with non-traditional borrowers' traditional credit profiles, we'll see on average about 13 total trades, open or closed, in their history at a big three bureau. To put this in context, in a random cross-section of the full credit spectrum, you'd find closer to 16 to 20 total trades on average. At any given time, about 3.7 of these are open and active. So these consumers, by and large, are indeed credit active in mainstream credit verticals that report to the big three. Regarding inquiry behavior, non-traditional borrowers average nearly 5 inquiries in traditional credit verticals in a 12-month period. Here we see a stronger credit hungriness than is usual in the general population. But the most striking characteristic of non-traditional borrowers is in their delinquency profile. Just over half had had a delinquency in the past 24 months, and also just over half had a collection item in the past 12 months, both signs of subprime and even deep subprime profiles. The credit hungriness, high rates of delinquency, and lower number of trade lines interrelate to describe these consumers' borrowing habits. Next, let's layer in non-traditional borrowers' alternative credit bureau profiles. These trade lines and inquiries are unique and additive to what is found at the big three credit bureaus. On average, you'd expect to find somewhere between 2 and 3 trade lines in an alternative credit file. You'll also find only a small share being open and active at any given time. This is largely driven by short-term lenders' wariness of loan stacking, in which a consumer takes out multiple short-term loans within a short window of time, effectively increasing the risk that he'll go delinquent. Real-time reporting of loan information helps detect loan stacking, as does the common scrub by short-term lenders to check for the presence of an open short-term loan at the time of application. Assessing inquiries, we find that nearly as many inquiries by the average non-traditional borrower are found at an alternative credit bureau as at a traditional one. This is fascinating but not surprising, given the credit hungriness of underbanked borrowers and their potentially greater difficulty to be approved for traditional credit products. It's worth noting that the inquiry dimension of alternative credit data is one where traditional lenders benefit greatly. The usual SSN, name, address, and phone number are collected on alternative credit inquiries. However, several fields are captured on loan applications that are not in many traditional credit applications. These include employer name, payroll type, and payroll frequency for the lender to understand repayment rhythms. bank account, ABA, and DDA numbers, since borrowers essentially must submit to automated drafting of loan payments by the lender. Even email address is captured for online loan applications. The consistency and stability of these historical data points on employment, bank account, and contact information are attributed and leveraged as an additional tool in underwriting applicant risk. Furthermore, non-traditional borrowers exhibit default and collection behavior in their alternative credit profiles too, and the prevalence of these delinquencies compared to a traditional bureau is somewhat in proportion to the number of trade lines found at each. I should note that non-traditional borrowers more often than not demonstrate satisfactory repayment of their alternative loans, and an alternative credit bureau file containing satisfactorily paid loans often serves as an asset to non-traditional borrowers seeking credit. Putting the two pieces together, we see that the comprehensive credit profile is completed by combining traditional and alternative bureau files. On average, a non-traditional borrower's comprehensive credit file has nearly 20% more trade lines and nearly double the number of inquiries, not to mention the rich stability information captured on the alternative loan applications. The percent of consumers newly identified as having delinquencies or collections doesn't rise as drastically, but just as important is all of the satisfactory loan payment behavior potentially present in the consumer's alternative bureau file that he or she deserves to get credit for when applying in mainstream verticals. Let's dig deeper into the contents of non-traditional borrowers' credit files. On average, about 9% of these borrowers have an open mortgage. This finding is commensurate with various demographic studies we've conducted of the underbanked population, which indicate that these consumers overwhelmingly are renters. Also, only about 39% of underbanked consumers have an open auto trade found at a Big Three bureau. Again, not surprising given the auto borrowing habits of non-traditional borrowers. We have tended to see a higher rate of buy here, pay here auto borrowing than traditional subprime auto finance among this population, much of which may be driven by difficulty in getting approved by a traditional lender. Buy here, pay here is another vertical that largely operates outside of the Big Three bubble. So just like with alternative credit, the true tendency of auto borrowing is likewise underrepresented at a traditional bureau. About 34% and 26% of non-traditional borrowers have an open bank card or retail trade, respectively. Those that do have open revolving trades tend to have very high utilization, averaging in the range of 95 to 100% utilization, with about a third of these consumers having a utilization of greater than 100%. The most common trade type of all to find in a non-traditional borrower's credit file is an unsecured loan, with about 45% of borrowers having such a trade type open at a traditional bureau. An unsecured loan can be a fairly broad definition at a traditional bureau, as it is basically a catch-all for any installment-type loan product not secured by some form of collateral. Thus, they include small or large unsecured cash loans or even student loans. Completing the picture are the unsecured loans in the alternative financial services industry and captured at a traditional credit bureau. About 12% of non-traditional borrowers have such a loan open at any given time. While unsecured loans found at a traditional bureau have the most similar look and feel to those found in the alternative credit sphere, there are certainly distinctions between the two. One such distinction is the average open balance amount. At a traditional bureau, unsecured loans have an average open balance of around $9,400, whereas in the alternative credit world, balances average about a tenth of that, around $965. Another distinction is that the lenders originating the loans are likely largely different. Many unsecured loans in the alternative financial services industry are originated by online installment lenders or specialty storefront financial services shops that exclusively pull from and report to alternative credit bureaus, not the Big Three. We'll finish out this segment on credit profiles by taking a comprehensive look at the average share of wallet of a non-traditional borrower. What is immediately striking, as we saw in earlier slides, is the heavy skew towards reliance on unsecured loans. This loan type makes up roughly 43% of the open trade lines that the consumer has outstanding and 34% of outstanding balances. To put that in perspective, the average share of open balances on unsecured loans is nearly the same as on mortgages, and this is averaged across the entire population. Some may wonder how this share of wallet picture compares to that of an average traditional borrower. Without a specific data analysis to point to, I'll speak from experience. Typically, you'd expect about 45 to 55% of the traditional borrowing population to have an open mortgage, whereas on earlier slides, we saw that in the non-traditional population, that mortgage holders are in the single digits. This aspect alone would drastically shift traditional borrowers' aggregate share of open balances to favor mortgage trades, potentially comprising 80% or more on average. Certainly, the share belonging to unsecured loans would be much smaller, easily in the single digits. So this really does strike a drastic contrast between traditional and non-traditional borrowers in terms of their share of wallet. I'd like to switch gears here briefly to touch on the public record profiles of non-traditional borrowers and the role that public record data can play in underwriting these consumers. First, let's acknowledge that public record data can offer a great deal of insight on non-traditional borrowers. For one, these consumers are several times over more likely to have a bankruptcy in their history than the general population. Almost 15% of them do. As well, roughly 44% have a derogatory public record of any kind in their recent past, which can include bankruptcy, judgments, or tax liens. Coincidentally, 44% have also changed addresses in the last 24 months. And this tendency towards low address stability agrees with FactorTrust's own address stability metrics on this population. One of the strengths of a public record data source is that it can typically capture data points of some kind or other on most consumers, underbanked or not. Even the lack of public records, such as property ownership in and of itself, can be useful to know. And FactorTrust has seen this type of data yield predictive enhancements to its models, particularly through the identity stability characteristics captured via public records. However, an issue we run into in the non-traditional borrower population is the dwindling predictive power that derogatory public record data has when the population is flooded with these characteristics. Presence of a derogatory public record tends to be a sharp razor for mitigating risk in the traditional lending space when the percent of applicants with such a characteristic is in the low single digits, and the default rate of the derogatory group is markedly higher than the counterpart group. But with non-traditional borrowers, of whom nearly half have a derogatory public record on file, the distinction in default rates between those with and without such characteristics is nearly non-existent. The value of the attribute is crippled by the sheer magnitude of its prevalence in the population. Complicating matters with public record data is the lack of a behavioral component, as changes to a public record profile occur usually more slowly than changes that occur in a credit file, by virtue of the types of data points being measured. Furthermore, with the context of public record attributes being largely outside of the credit domain, there is little financial insight to draw when attempting to use such data to predict the outcomes of credit transactions. Let's take a look at a few examples. Our first example shows the impact that public record data made in enhancing an alternative credit score designed to predict the likelihood that a lender could recover delinquent debts from consumers that had gone into collections. Within the population of delinquent consumers that were a hit to the Alternative Credit Bureau, which comprised about 80% of the sample, layering in public record data drove about a 6% lift in KS, which was the statistic used to measure the ability to distinguish those consumers most likely to pay versus those least likely to pay. The lift was nice, but marginal in light of the KS achieved using a model driven solely by alternative credit attributes. Where the public record data showed the greatest value was in its ability to expand the scorable population to almost 100%, a 25% relative lift in coverage by scoring consumers that were not found at the Alternative Credit Bureau. However, the predictive power generated when using public record data alone in this population was less than half that of the model driven by credit data alone in the HIT population. There was very clearly a trade-off here between the expanded coverage and the limited predictive power. Our second example comes from an alternative data risk score that FactorTrust recently developed to predict default on short-term loans. For the model development, the borrower population was split into two mutually exclusive regions, hits and no hits as of time of the application to our alternative credit database. Within the HIT population, our alternative credit attributes were calculated off of the consumer's alternative credit history. And in the no-HIT population, there was no alternative credit history available, and thus the attributes were not calculated. Other data sources in the model were traditional credit bureau attributes, checking and savings account behavior attributes, and public record attributes. The results of the model development exercise lent further support to a common theory in scorecard development that like predicts like. In short, when predicting a certain type of outcome, the full breadth of information the credit file offers can be very helpful in making the prediction. However, the past events in the file that are the most similar to the future event being predicted tend to generate a greater share of the predictive power. If you've ever seen the Yahoo Finance articles on what the most important ingredients to the FICO score are, what is always listed as number one? Delinquencies. What is the FICO score designed to predict? Delinquencies. When it comes to delinquencies in a specific vertical, in my background developing credit models, I've seen the phenomenon repeat itself time and again that behavior from the same industry takes center stage in the prediction, and I continue to see that now at FactorTrust with short-term loans. So it came as no surprise in this model development exercise that within the Alternative Bureau HIT population, the Alternative Bureau attributes drove about 75% of the predictive power. The next strongest source was the Traditional Bureau attributes, contributing 14% of the predictive power. Public records in this segment only drove 2% of the predictive power. Turning our attention to the Alternative Bureau no-hit population, we see the next most similar data source, the Traditional Bureau attributes, filling much of the void and representing 65% of the predictive power. Public record data had a stronger showing here with 17% of the predictive power compared to the 18% contributed by checking and savings history. To summarize this section on public record data as an alternative data source, we've seen its advantages for expanding coverage and acknowledged its usefulness for identity stability attributes, but the lack of predictive power or similarity to credit outcomes are limiting factors to its usage as a go-to alternative data source. We'll begin our last section on how to use alternative credit data in traditional lending with the results from the third and final poll question from our recent survey. We asked respondents in what way or ways they might evaluate or use alternative credit data in their credit decisioning in 2017. We found their responses quite insightful. The most frequent choice was loss mitigation, with 68% of respondents indicating this use case. A little more than half of respondents indicated that expanding their scorable universe and/or giving rejected applicants a second look were of interest, and about 42% selected enhancement of risk-based pricing. You'll find in this how-to section at least one example of each of these use cases from the poll question in action. I'll walk us through several real-life demonstrations of how FactorTrust's traditional lending clients, particularly those in the auto vertical, have used or evaluated alternative credit data for credit decisioning. The exact clients and the specifics of their portfolios have been anonymized. Let's begin. First off, let's cover some basics for traditional lenders about integrating non-traditional credit data into their strategies. There is no one correct way for all lenders to consume alternative credit data. We have clients in traditional verticals using our credit data in a decision tree format, in a dual matrix against a traditional credit score or custom model, as an ingredient embedded into their credit model, or even as an event-based account management trigger. All are acceptable, and the method of consuming should be tailored to the client's unique strategy and business model. Secondly, traditional lenders should not approach alternative credit data as a replacement for an incumbent traditional credit source. Let me repeat that. Traditional lenders should not approach alternative credit data as a replacement for an incumbent traditional credit source. Just as we saw in the examples a moment ago that like predicts like, if a lender is originating loans in a certain traditional credit vertical, they will need to pay close attention to the consumer's behavior within that vertical found in their traditional credit file, as it has a strong bearing on future performance. What the lender should do is view alternative credit data as a critical piece of the consumer's overall credit profile that they are missing out on if they are only using traditional credit. As we saw earlier in our examination of the non-traditional borrower credit profile, these borrowers have very distinct behaviors and financial styles, even when considered within the walls of a traditional bureau. The most effective way to segment and identify these consumers is by querying against an alternative bureau. Finally, we'll see in these following examples some very interesting and profitable interactions between the traditional and non-traditional bureau worlds. Let's begin with an example from a full-spectrum auto lending client who has 3 credit grades defined by traditional credit characteristics, and the highest tier represents the best risk level of the population. We found that the hit rate to the alternative credit bureau within this best risk population was the lowest, about 3%. To contrast that, the hit rate in the worst risk grade was 10 times that, about 32%. The key finding in this study was that the loss multiple driven by the alternative bureau hit in the highest tier was 7.7x. We calculate loss multiple as the ratio of the bad rate in the alternative credit hit population divided by the bad rate in the no-hit population. In this case, the bad rate in the hit population was 7.7 times the bad rate in the no-hit population. In fact, the bad rate within the alternative credit hit population in the highest tier matched the average bad rate in the middle tier. So for this auto financial service provider, even with alternative credit hits generally having such a subprime behavior about them, due to their pristine performance at the traditional bureau, a top-tier hit did not necessarily mean a decline. What it meant was a right pricing opportunity, wherein alternative credit hits in the highest credit tier could be repriced with middle-tier components of LTV, term, APR, stipulations, and amount financed to assign the appropriate risk-based pricing to the applicant. Pretty simple example. Let's move on to a slightly more complex use case, the decision tree. For a different full-spectrum auto lender, alternative credit data was assessed both within the approved population and the declined population. Within the declined population, FactorTrust conducted reject inferencing using an industry-standard parceling technique to infer what the risk likely would have been had the declined applicants actually been approved. For both approvals and declines, markedly lower risk and higher risk subpopulations were identified using alternative credit data. The first opportunity identified was a right pricing opportunity within the approval population. With alternative credit data added to the mix, the auto lender discovered the potential to increase the volume of a lower risk credit tier by 26% through swapping up approvals from a worse risk tier. Consumers in the swap-up group demonstrated positive short-term loan performance and solid consumer stability characteristics within their alternative credit file. To the lender, this swap-up opportunity represented the potential to expand their business with this swap-up group, as the lower risk tier offered more flexible LTV requirements, lower APRs, and hence higher conversion rates of the borrowers offered these deals. The risk level of the loans were also indirectly improved by the more favorable pricing that the swapped-up consumers received. It was a win-win. The second opportunity was a right pricing swap in the opposite direction, wherein the lender was able to identify a consumer group that had a 3x loss multiple between the hit and no-hit populations to alternative credit data. This swap was similar to the first example in that the lender was able to still approve the consumers, but with the deal structure that was the most appropriate given the true risk profile of the consumers. This swap was only made possible by layering alternative credit data into the traditional credit framework. The final opportunity involved a cohort of applicants within the traditional credit decline pool that had markedly low risk profiles when assessed with alternative credit data. Again, positive repayment performance and solid stability metrics merited these consumers a second chance. Giving these rejected applicants a second look yielded the potential to increase the volume in the lender's lowest approval grade by 12%. The key takeaway here is that the information found in an alternative credit file has the potential to adjust a lender's decision up or down based on risk. Just like with a traditional credit file, an alternative credit file contains information on satisfactory and unsatisfactory payment on loans, inquiry frequency, balances, high credit amounts, etc. These alternative credit characteristics, along with stability and employment characteristics captured by FactorTrust, have great potential to adjust the lender's ultimate pricing or approved decline decision to a higher or lower tier of the decision strategy. Let's move on to a more complex strategy that involved an auto client dual matrixing a traditional credit score shown along the y-axis with an alternative credit score shown along the x-axis. Before I get started with the demonstration, it will behoove me to describe this very colorful landscape that we painted together with the subprime auto client in question. First, note that the traditional credit score along the y-axis did have some traditional credit unscorables, meaning that there was either no footprint at the traditional credit bureau, or else that footprint was so dainty that it held insufficient information to actually score the consumer. Next, the traditional and alternative risk scores were both split into deciles, wherein decile 10 is the best risk decile and decile 1 is the worst risk decile. Next, note that throughout this matrix were approved, rejected, and booked accounts. The traditional credit score in the y-axis was used as one element in the decision strategy, alongside low side and high side overrides. Approvals tended to be ranked higher and rejects tended to be ranked lower, but a sizable mesh of decisions and booked good and bad outcomes for this very large subprime auto client exists throughout this matrix, validating our analysis with a minimum critical sample size no matter where in the matrix we choose to look. The numbers in the matrix describe the ratio of the default rate in the specific cell to the average default rate of the entire row. Let's walk through an example. To demonstrate, let's say the default rate of the entire traditional credit unscorable row was, on average, 30%. It wasn't, but I made that number up purely for demonstration purposes. Then, armed with the understanding that the value of each cell describes the ratio of the default rate of the cell to the default rate of the row, we can see that the default rate of alternative risk score decile 10 within this traditional unscorables row was 16.5%, or 0.55 times the 30% row average. Similarly, the default rate of alternative risk score decile 1 in the traditional unscorables row was 45%, or 1.5 times the 30% row average. Just for good measure, let's consider one other row. Let's say the default rate of traditional credit risk decile 10 was 10%. Again, it wasn't, but let's pretend it was. Then the default rate in alternative risk score decile 10 would have been 6.5%, or 0.65 times the row average of 10%. Furthermore, the default rate in alternative risk score decile 1 was 18.8%, or 1.88 times the 10% row average. In this way, we can see that there are certain cells within the traditional credit no-hit population that had lower default rates than cells within the very best traditional credit score decile, but these were only revealed when alternative credit data was considered. So let's walk through the opportunity areas of this matrix. First, the client found a definite loss mitigation opportunity in the matrix. For those consumers still being approved within the highest risk traditional credit deciles or within the no-hit population, having a poor alternative credit risk score confirmed that these were accounts best declined. The losses averted in this portion of the matrix easily outweighed the few good accounts that were sacrificed. Next, in the middle and upper tiers of the traditional credit spectrum, the client found significant right pricing opportunities. For consumers in the best 3 alternative credit deciles, these consumers could be graduated into better credit grades with more favorable pricing, conversion, and outcomes. For consumers in the worst 3 alternative credit deciles, these consumers could be right priced into a higher risk tier that would still yield an approval decision, albeit with loan terms and stipulations more appropriate for the heightened risk level of these consumers. Finally, the client found some universe expansion areas of the matrix where approval criteria could be relaxed for applicants that demonstrated more favorable alternative credit profiles. Each of these adjustments to the subprime auto client's decision was made possible only by considering alternative credit data in the decision process. The last example will demonstrate the usage of alternative credit data for account management purposes. Consider the most simple of events involving alternative credit data, first-time entry to the alternative credit universe. When FactorTrust conducts a data test for a client, one of the first steps we take is to assess the alternative credit hit rate of the consumers in the sample, both at the original application date, but as well during the time between the original application date and the time of the study. In the example shown, the applicant population of the full spectrum auto client demonstrated a relatively subdued 12% hit rate to the Alternative Credit Bureau as of the time of the original application. These applicants demonstrated a default rate that was 2.4 times higher than consumers that had never entered the alternative credit universe. However, in the ensuing 24 to 48 months between the initial application date and the date of the retro study, an incremental 18% of the borrowers in the sample hit the Alternative Credit Bureau for the very first time. These were hits that only entered the alternative credit universe after the initial loan decision was made. Interestingly, the default rate of the borrowers that entered the alternative credit space after initial loan application was 2.2 times that of those that never entered the alternative credit space. This event of entering the alternative credit universe for the first time can be extremely powerful to traditional lenders. Armed with this information and other event-based triggers that FactorTrust captures, the lender could have taken specific account management actions to mitigate losses, such as prioritizing collection efforts when borrowers in this group went into delinquency. We'll finish off this how-to section with the big takeaway that traditional lenders should tailor their usage of alternative credit data according to their traditional risk bands. We've seen that applicants with traditional generic risk scores above 700 tend to have low hit rates to alternative credit sources, but the loss multiples for these applicants tend to be the highest. A hit to an alternative credit bureau should not necessarily mean a decline, but more often a right pricing opportunity. For applicants with mid-grade traditional risk scores, expect a moderate alternative credit hit rate and loss multiple. We've seen right pricing opportunities here where lenders can go beyond simple hit and no-hit classifications and begin using the information contained within the alternative credit file for basic hit plus and hit minus ranking strategies. Loss mitigation also becomes a possibility in this mid-grade traditional risk band, as high-risk applicants could be declined to avert disproportionate losses. Finally, the higher risk grade traditional credit tiers, generally below a 600 score, will most often see the highest overlaps with the alternative credit universe. The high hit rates tend to diminish the pure hit versus no-hit risk differentiation, but they also open up the potential for the content of the alternative credit file to drive significant differentiation. More advanced grading using A through F risk grades or alternative credit scoring models enable advanced decisioning strategies. As well, lenders operating in this space could see opportunities both for universe expansion and loss mitigation as swap ups and swap downs become increasingly more equally likely. We'll close with a summary of actions that traditional lenders can take now to discover, evaluate, and implement alternative credit data into their decisioning processes in 2017. We recommend that traditional lenders begin by conceptually exploring the universe of alternative credit data, and webinars like today's are a big part of that. Learn what providers are out there, the nature of their data, and hypothesize how it could help achieve or exceed your 2017 performance goals. Next, traditional lenders can diagnostically evaluate the power of alternative credit data through retro tests on their historical portfolios. They may conduct such tests on traditional credit data today with the help of the big three bureaus, and FactorTrust offers the same robust retro scoring capability of its alternative credit data. Lenders will unearth insights about which aspects of applicants' alternative credit histories are most correlated with positive or negative performance outcomes in their unique population. Our in-house analytics team of top-notch statistical consultants collaborates with lenders to design and conduct the analysis, and we help lenders interpret and quantify how the results tie back to their bottom lines. Finally, after determining where and how alternative credit data should be woven into their decision strategies, traditional lenders should proceed to implementation. The technology component of this process can sometimes present a bottleneck, and the timing of the implementation stage oftentimes can be very long. To help ease the burden, FactorTrust's experienced customer care team actively helps lenders integrate directly via our API. Alternatively, lenders can call their traditional bureau representative to ask them how they can access FactorTrust data through their platform in 2017. That concludes the presentation content today, and at this time, I'll pass it off to Christine to moderate our question and answer session. Christine?
Thank you for your presentation, and especially sharing your key learnings and insights, Dan. As Dan mentioned, we are moving into the live question and answer portion of today's presentation, and I encourage you to use the chat function to submit your questions since we are on mute. It looks like time might be a little short. We'll try to respond to all of the questions as time allows. Any unanswered questions, we will respond through email or a phone call for follow-up. Let's see. Looks like we have a few questions coming through here. Here, Dan, here's the first one. How is FactorTrust alternative data regulated?
All right, good question. FactorTrust's consumer credit data is FCRA and ECOA compliant. Our consumer credit report contains all of the raw detail about trade lines, repayment performance, inquiries, etc., that feed into the credit attributes. We are a credit bureau with all of the same regulatory compliance responsibilities that the big three bureaus have regarding consumer dispute and disclosure.
Okay, thank you. I have another question here. It says, what kind of coverage does your organization have, meaning FactorTrust, in the alternative credit data space?
Yeah, the FactorTrust Alternative Credit Database contains over 22 million consumers and counting. Roughly 500,000 new unique consumers enter the database per month. Over 225 million transaction records for these consumers exist in the database.
Okay, thank you. We've got a few more minutes for questions. If you would please submit those to me, the host, Christine Cornwell. Here's another question. What kind of fields does your alternative trade line data include?
Yeah, sure. So in our file, you'll see loan performance data, consumer stability data, application inquiries, employment and income data, and our employment and income data is stated, not verified. Now, within the trade line segment in particular, you'll find the typical fields that a traditional bureau has, so think open dates, high credits and credit limits, balances, delinquency statuses, etc. Given the nature of the loan products in the industry, though, we also typically see greater detail on the individual ACH payment events and dollar amounts, which bank accounts they come from, and which return codes may be returned. Information captured on inquiries lends itself also to deep insight into the consumer stability, so this is regarding address, phone, email, bank account, even IP address for online applications. Good question.
Here's another one. Do you have any other information beyond credit data that you can get at a traditional bureau?
Yeah, absolutely. As mentioned, the consumer stability data we capture comes from the inquiries that are really off the traditional grid. All right, lenders serving this space, our kind of core underbanked space, oftentimes are not even pulling from the traditional bureau. All right, so we're capturing unique inquiries. We also capture and attribute more fields than the big bureaus typically do. The same goes for stated employment and income data, ACH performance, and banking relationships.
Thank you. Well, it looks like we're almost at the top of the hour, so with that, all the other chatted questions that we haven't responded to, we will respond to directly. Also, if you'd like to review today's materials at a later date, you will receive a copy of the slides as well as the recording of the session. So with that, this concludes today's presentation, and I would like to thank Dan for taking the time to be part of today's presentation, and also especially thank everyone who has taken the time to participate to join us today. Thank you.